call attention to our creative services team. Anything that you would want to do for marketing, agency solutions, digital solutions, turnkey solutions, we can brand all that with your logo on it, and help you get that out to clients. Again, the heartbeat of this business is marketing, reaching new clients, staying in communication with your existing clients, a ton of tools. And again, our creative department is located just a couple offices down from mine, and I've had great success in working with them. Another thing I'd like to point out that we can do here, especially going into the new year, is work with you on a complimentary marketing analysis. It's about a half an hour phone call. It's with our Chief Marketing Officer, Curtis Hawks, and we can help you tailor your sales needs and what you're going to do for the next year. It's always hard to work on the engine while it's running, but this is just a great chance for you to step back, objectively take a look at your business, and see where there might be some tweaks or some changes you can make to help grow your business. We also have a wealth management division at IMES, owned by IMES. So if you don't have your 6 or 63-7, we have resources there. So if you run into a client that has assets under management and you need some consultation on that, Chad and Zach over at IAMS Wealth are fantastic. They're good friends of mine and also very responsive. Last, we just finished, or I shouldn't say last, but we just finished up with our Life and Annuity Academy. We have 4 or 5 of these a year. You come in, it's about a 2.5-day session. We pay for everything, your flight here, your hotel. And last time here we had one, we had 15 different speakers, everything from product to marketing to marketing services. Just a great chance to be in a room with your peers, share ideas, and learn from some of the industry leaders. We'll be booting up our next one, I think, in March, and I want to make sure that anybody who is interested in coming in would have that opportunity. I'd also ask you to follow us on Facebook and LinkedIn, and we'll follow you back. Liking each other's posts and commenting on them are just going to put more touches out for everybody. So please follow us on social media. And then last, thank you very much for joining us. If you have questions, please give us a call at 800-255-5055, and we will be contacting everybody that has signed up for the webinar and see if you have any questions. With that, I'm going to attempt to turn it over to Brent, but I'm having a little bit of a technology issue here. Here we go. And Brent, I am going to turn it over to you now.
Wonderful.
Make Brent the presenter.
All right, let's just make sure that I can forward these here in just a minute, but thank you. Apologize for the technical difficulties here, but certainly appreciate you coming out today. Do have some very exciting things to talk about, and obviously some opportunities in our annuity care suite. And largely, we're talking tax deferred to tax free. And anytime you're talking to taxes or talking about taxes to your clientele, their ears are largely going to perk up and want to hear what you have to say. And so I'm hoping to give you some great ideas and some opportunities here within the OneAmerica Annuity Care Suite, and making possibly an existing annuity tax-free if used for long-term care. Now, I also want to show you some ways that we can leverage that money as well. So maybe it's just new money. Maybe it's you're working with your client, they've got amounts of cash or things of that nature they want to use for an extended care plan. We've got opportunities for that as well, and I will get into that here in just a moment also. So Chad, just verify that the slide didn't move, please. So first of all, I want to talk about OneAmerica Financial as a company. We are an Indiana-based company, so that's our tower right there in downtown Indianapolis. And as a matter of fact, we just put our new logo on the top of that building. So this picture is a little bit older in that regard. But look, it's not about a building. It's more about the people, the solutions, and things that we can do to help your clientele. But I just want you to know that we can trace our roots all the way back to 1877 as an insurance company. So we've been around a long time. We've got all the financial strengths, A+ rated from AM Best, 95 Comdex. So if any of those are important, the S&P 500 there, the AA-. So all of that just speaking to the financial strength of who OneAmerica is. We are a mutual company, and that is something that I would think most of you and maybe presenting solutions to your clientele would be very grateful for, because being a mutual company, we report to the people that own our policies, not a stockholder. So we are always trying to do the best, what's in the best interest of any of our policyholders, because they're eventually who we report to. And I do want to talk about innovation. We're the first to market any of these asset-based solutions. So when we're planning for long-term care, there's a number of ways that you can describe them: asset-based, hybrid policies. And today we're really going to be focusing more on our annuity chassis. So we're the only carrier. Well, I shouldn't say that. Actually, that just changed. We are one of 2 carriers now with a platform specifically for long-term care planning, with both life insurance and annuity platforms. So we've been doing this for 37 years. And why is that important? Well, largely we've got claims that we've been administering longer than some of our competitors have actually been in the business. So just wanted to impart some of that wisdom, if you will. So when I move forward, none of these are going to flip through like I wanted to, but I really wanted to talk about the silver tsunami and really what that is. Hopefully you've heard of this term before, and really, what we're doing to prepare for it. And anytime you're talking to your clientele about any kind of extended care planning, and quite honestly, I try not to use the word long-term care planning anymore, because that somewhat has a negative connotation. Because when you say long-term care, many consumers automatically think of the nursing home, and that's not where anybody really wants to go. So I tend to talk about it in an extended care plan or extended care planning, and that really can overcome this silver tsunami that is coming. If you haven't heard this term, you can look it up on Wikipedia, but it's been out there for some time now. And it's really the aging of America. And to really kind of show you a little bit more of that, I did put this huge tsunami that is going to hit this area, and you can see there's some people down there towards the bottom of this picture, and how quickly they're just going to be wiped out. And that's really kind of what's happening in the healthcare world if our clientele do not have a plan for extended care needs. They will get wiped out by this silver tsunami as well. So let me talk just a little bit. There's a lot of numbers on this slide. It's fairly busy, but I'm only going to hit on a couple different things. Back in 2000, the annual LTC expenses listed were $30 billion. So yes, that's a big number, but it pales in comparison to a lot of other industries out there. But we started to see the first baby boomers, and I say the aging of America because it's really more than just the baby boomers, but baby boomers are really adding to this silver tsunami as well. So back in 2011, the first boomer turned 65. 2015, now with boomers in that kind of space, 65 plus, obviously we had a lot more of the golden generation probably receiving claims, but we saw a 750% increase, up to 225 billion in expenses. So, again, a large increase just over that 15-year span. Now, if we look to the future in another 15-year span, it's going to be probably even a larger increase that we're spending on extended care needs. The other thing that I wanted to talk about, the government is also preparing for the silver tsunami. So the government many times gets some things wrong, if you would agree with me on that. I mean, many times they're trying their best, but sometimes they find out dire or unintended consequences from changes that they've made. But the government really got this one right. They've been trying to prepare for the silver tsunami basically since 96, changing different laws. HIPAA back in 96, the Pension Protection Act, which we're going to talk a little bit about today, Deficit Reduction Act, the DOL rules, that sort of thing. Washington Cares, I don't know if you heard about that. If you happen to be in Washington, of course you did. And then there were 12 more states that were talking about putting legislature in to say if your clients had an extended care plan, they would not be taxed. So there was a number of those states. Some of that has subsided for a little bit, but really all of these things that the government's been doing is really trying to help clients understand, especially the more wealthy Americans, that they need to do a good job of planning for themselves. Yes, we've got Medicaid that will pick up some of the bills, but that's really for the destitute, those that cannot afford to plan for themselves. And so the government is trying different ways to make sure that we could plan for our own needs. Is care likely? I'm sure you've probably heard this stat that 70% of those Americans turning 65, there's almost a 70% chance of needing some form of extended care services in their lifetime. And beyond that, 20% of those are going to need it for 5 years or longer. So I like to mention that because many times a lot of our competitors and advisors that we're working with are working with their clients to put a very average plan in place, meaning, hey, we'll just look at what the averages are for the need of care and plan for that. Well, that's going to be under 5 years. And if 20% of your clients, so if you have 10 clients only, and I'm sure you have plenty more than that, but if you had 10, which two of those do you want to say, hey, I'm just going to plan for the average with you and you're going to outlive our extended care plan there? Probably that's going to be a difficult decision, right? Obviously, you want to help your clients in any and best ways possible. So thought I would just kind of quickly give you that information as well. All right, so there's two phases of annuities, much like a retirement plan. Basically it's the same sort of thing. So there's accumulation and growth within annuities, right? So one purchases an annuity and then lets it grow, right? There's interest rates that are afforded to that, and the best day of that consumer's life that has an annuity in their portfolio is every annual statement day. They get to open that annual statement, they see what that money has grown to, and they think, what a great solution this was. So accumulation and growth is certainly the first phase, but then there's the payout and distribution and how to access that. Many of these annuities are what's called non-qualified annuities, meaning they purchased that annuity with after-tax dollars. And why they looked at that was they liked the deferred growth, so they're not taxed on any of that growth until they actually go to utilize it. So it continues to grow, continues to grow, continues to grow. But all of a sudden now, when they get to be a later age, and I'm saying maybe 70, 80, they're taking RMDs, whatever the case may be, they have to start looking at that annuity and they see all this embedded gain. And they say, well, now that's a tax liability. I don't want to touch that money, largely because anytime I do, I'm going to be taxed on all of the gain first. So last in, first out. That's what a non-qualified annuity really is, right? So the payout and distribution is something that really these consumers look at and they say, I can't touch that. It's going to drive me into another tax rate. It's going to affect my Medicare premiums, my IRMA. I'll be taxed federally and state-wise, that sort of thing. So really good to understand these two phases of annuities. Some other facts and figures that I'd just like to impart. So the oldest baby boomer in 25, starting January 1st of 2025, was 79. So we know that then next year, January 1st of 2026, the oldest boomers, and that would be 10,000 of them on January 1st, and then every day thereafter are going to be turning age 80. Why do I impart this information to you, or why do you want to know that? Well, largely the LTC industry for years has said any type of claim situation typically starts between the ages of 80 and 85. So if we know that the first boomers are going to be turning age 80 January 1st of next year, and 10,000 of them every day thereafter, how much is that going to drive the demand for this type of protection and or services? The other thing I want to just impart here is that, you know, the annuity space is huge. Over $2.3 trillion in retirement assets are annuities. And as a matter of fact, look at just the sales for 2024, last year, $405 billion in annuity sales. So this market is huge. Many of your clients may already have these non-qualified annuities in their portfolio. As a matter of fact, many of them probably do if they're of 50 or older. So Gallup, the industry that does polling. There's actually one here in Omaha where I'm based, a nice little campus right downtown on the way to the airport. But they do a poll of non-qualified annuities every other year. And so this came from their 22 poll that they did, but there were some really interesting numbers that came out of this. And they just asked these non-qualified annuity owners, why would you intend to use that annuity money? And it's really interesting to kind of look at the minds of the consumer and just kind of know what their reasoning was behind why they, purchased that annuity in the first place. Well, 84% said they want to use it as a financial cushion in case they or their spouse outlive their life expectancy. 79% said they wanted to avoid being a burden, a financial burden to their children. 67% said they're going to use it really as an emergency fund or really for nursing home type of care. So all three of those high percentages really speak to extended care planning. And that's why that's the mind of the consumer thinking. We as advisors and insurance professionals need to be talking to our clientele about doing some sort of extended care planning. So it's really the onus is on us to provide them some information. Now, that's not a one and done sale. Typically you're going to provide them some maybe third-party material or insurance carrier material. Let them start the process. So really you're planting the seed, right? And let that process percolate and let that sprout, if you will. And then many times they will come back to you, or it really gives you the right then, maybe on your annual reviews or anytime you're talking with your client, hey, have you looked over that extended care planning material yet? This is something that we do need to address because it's probably your largest uncovered risk to your financial plan. So again, the onus is on us. The consumers are asking for this information. Now, why do I give you that? Well, I talked about the Pension Protection Act. It was actually crafted back in 2006. However, it went into effect January 1st of 2010. And the Pension Protection Act, why do I mention this? We're not talking pensions here, we're talking annuities. Well, largely the Pension Protection Act, what it did was really pension reform, right? But there was Section 844 of this act that deals specifically with annuities and tax advantages for long-term care. So that's why I really bring this up and wanted to impart some of this knowledge. So again, as of January 1st, 2010, so we're now 15 years into this Pension Protection Act legislature, where it said cash value withdrawals from specific annuity contracts. And when I say specific, I'm really talking about non-qualified annuities. And I'll give you more information on that here in just a minute. But basically, if they would just 1035 exchange, so move from the existing annuity that they have in their portfolio to what's called a Pension Protection Act eligible annuity, then what they could do is shed all of that existing gain in that contract. So remember, they purchased it with after-tax dollars. It was growing on a tax-deferred basis. But the reason they don't want to touch it now is because it's become more of a tax liability. But just by simply 1035 exchanging into what is called a PPA annuity, which all of ours here at OneAmerica Financial are, then they can mitigate or get rid of any of that taxable gain in that contract. Now, that would be past growth and any future growth. So just because you're moving from one annuity to another doesn't mean it stops growing. As a matter of fact, we offer a number of benefits that are good for them just to do a simple 1035 exchange. And I'll get into that process here in just a little bit. But really, I wanted to show you kind of how this works, if you will. So on the left-hand side, why really this PPA legislature is so important. Like I said, over 15 years now that this has been in place. So here's an annuity without the Pension Protection Act coverage, if you will. You've got your cost basis, you've got the growth, no tax benefits. So every dollar that they take out of this particular annuity is going to be hit with federal, state, provisional income, Medicare premiums. All could be affected. Putting them into a new tax bracket, all of that could be affected by taking distributions out of that existing annuity in their portfolio many times already. However, we just do a simple 1035 exchange. And I'm going to show you exactly what that requires here in just a moment. But we move it to a PPA eligible. Again, all of ours are PPA annuities. Now, if they use any of that money for long-term care purposes, it's all tax-free. And again, I will stress the fact that if you talk to your clients about a mitigation strategy for taxes, of course they're going to listen to what you have to say. So just know that this all stems from a now over 15-year-old tax law that is out there. So very simple 1035 exchange into a PPA annuity. Now any of that money that they use will be tax-free for any long-term care services. So great way to help your clients mitigate taxes. Now, if you'll remember that Gallup poll, all of those pieces were really lending towards the reason that they would use that is for long-term care services. So one thing that I do need to caution you on, because there's a number of annuities that are out there, and I want to really quickly go over what is not a Pension Protection Act qualifying annuity. So those that have a nursing home doubler or a nursing home waiver, right? A Medicaid annuity, those are not PPA eligible annuities. It must have some policy language around the 7702B IRS code. That's down there in the difference. If it doesn't have that policy language within that annuity, it's not a PPA annuity. And qualified money. Qualified money is not what is offered by the Pension Protection Act tax services, if you will, because qualified money they used on a pre-tax basis, right? They may have taken that out on a pre-tax basis, and so now that does not work with the Pension Protection Act. So just know we've got solutions for qualified money in our annuity suite as well, but it just works a little bit differently. So it's vitally important that there's some annuities out there like these doublers, these nursing home waivers, that sort of thing, that act kind of like a PPA annuity, but they're not afforded that same tax deductibility. Now, I want to show you kind of the concept of a deferred annuity with long-term care benefits and explain exactly what we're talking about here. Here's a very well-balanced portfolio. And essentially all we're going to do is peel a portion of that portfolio out and leverage it for care. Now we can do that 2, 3, 4 times, maybe even more. And I'm going to talk to you about that as well, even up to a lifetime. So this, the title of this was really, 4 times leverage and what a great opportunity it is. I'm going to show you a way that we could even get more leverage out of this as well. So really a great way to plan for any extended care needs. So I like to give you the timeline of these solutions as well. So if and when your client does maybe a 1035 exchange or just uses cash, puts it into one of our annuity solutions, remember, it's all going to grow tax-free as long as it's used for long-term care. Any past gain would also be tax-free if we're doing a 1035 exchange. But when that first day of claim arises, what we're going to do is invade that policy, right? So here we're talking any of our annuity solutions. So we go to the cash value in that annuity and we start using that for the monthly benefits available or payable for any extended care expenses. So just know that they're going to use their asset first. That's why we call these asset-based solutions. So they're going to use their asset first, but then we've got the ability at claim, or excuse me, not at claim time, at application time, to add what we call an extension of benefits or a continuation of benefits, if you will. And that's what we call a continuation of benefits rider. And that can extend the time that that base policy pays out. So once that base policy is exhausted, that's when the continuation of benefits rider would kick in. And that could be a limited portion, or like I said, even greater than your 4 times leverage. Why not make it available for the life of that individual? So I wanted to really quickly show you how that worked. Now, there are 3 reasons that we use our annuity care suite versus our life chassis. Right now, our business mix has been changing. It was just last year, maybe towards the beginning, it was about an 80-20 mix, 80% life, 20% annuities. But over that time frame, our annuity segment has really been growing. And we're about 65-35 now, so 65% on the life side, 35% for our annuity suite. And so I like to impart that to you just so you know that we're seeing a lot of growth in this area. Really main 3 reasons that we're using annuity care versus our life chassis is ages. So we'll go up to age 85. And I don't know if any other solutions that you can find out there for extended care planning that can go all the way up to age 85. It could be for health reasons. You know, there's no mortality risk, if you will. So no medical records, no labs, parameds, any of that. Yes, we are underwriting still for the morbidity risk, the long-term care risks, if you will. So we will do a cognitive screen. We'll do a script check and we'll do an MIB check. But that's really it, and some knockout questions, I should say, as well. So we have to do some form of underwriting to be a PPA eligible annuity, and that's really it. So a lot of differences there. And then any of those that are non-qualified annuities out there with lots of embedded gain outside of their surrender charges is a great opportunity to just do a 1035 exchange and move it into a a tax-free avenue, if you will, for any long-term care services that they do need. Now, there's one thing that if you've been working in the insurance market for any amount of time, you know that when we're talking about 1035 exchanges, there's rules that go around them, right? And so many of these non-qualified annuities are singly owned. So whether they took them out prior to being married, whether, through that life process, they just decided that, hey, I'm going to take one out and not have one on you. There's few that are joint owned, and we can use those as well, but many of these are singly owned. What's great about our solutions is that we've got something called an eligible person provision. And essentially what we do is still make this, we 1035 it, still singly owned, but we can add that spouse, and it must be a spouse. So whatever the laws of your state are regarding a spouse, as long as it's their spouse, we can add that individual as an eligible person. So now we can give joint access to both individuals to really maximize the tax savings that they could get out of that annuity. So this is a great way to really help your clients and, again, mitigate taxes. Now, if it's a jointly owned, we just do a 1035 exchange, still jointly owned. So same thing there. I really like this provision, and I love to hit that pretty strongly. Now, we have 3 different solutions in our annuity suite, but I'm only going to focus really here on the last 2, and I'm going to give you some case examples around this, and then talk about how the process is to really put one of these plans in place. So know that I'm going to focus on Annuity Care 2 and our indexed annuity care strategy. Annuity Care, the original Annuity Care, the first one up there, that was the first one that we came out with, but we've since come out with these other solutions, and really seems to be more what the clients are looking for out there. So let me start with Annuity Care 2. A lot of information on the slide. Now, I was going to, show it where I'd pull in pieces, but you're going to have to deal with it this way. So I apologize for that. But let's just start on the left-hand side here. Annuity Care 2 is what we're calling this particular solution. And here's the base policy. So again, it's a base annuity. And we can do either a single or a joint. And it depends on how quickly that pays out, whether it's a single individual or a joint. If it's a single individual, we pay that annuity amount in 24 months. So essentially, we take that account value, if you will, divide it by 24 months. That gives them their monthly benefit amount that is available out of that base annuity. If they do add an eligible person, or if it was a joint contract that came over, now that's going to pay out over 30 months. So just know that depending on single or joint, it's going to pay out in different amounts of time. Ages for these, 40 up to age 80. So like our life chassis, this one only goes up to age 80, and I'll give you some higher ages here in just a moment. But again, it can be single or joint. It's a deferred fixed annuity, and all benefits for LTC are tax-free. So where can we fund these? Well, cash lump sum. Many of your clients just have cash that they want to say, I want to single pay something and be done with it, right? So we do that. Non-qualified annuities in a 1035 exchange, even cash value life insurance, we could do on a 1035 avenue as well. Now, what Annuity Care 2 is, it is truly a single pay and done. Set it and forget it. The reason why I say that is this is our only solution here at OneAmerica that has the continuation of benefits rider built in. So automatically coming with this base policy is that continuation of benefits rider. And here's where we're going to leverage that. Now, we've got competitors in this space, and one of our competitors leverages it based on underwriting criteria. We don't do that. We base the leverage that we're going to give in terms of how old they are. So from 40 to 69, we're going to give them an extra 72 months of coverage. So 4 times leverage here, if you will. Now, if they do happen to be 70 up to age 80, we don't give quite as much leverage just because we don't have as much time to use that money, of course. So that's an extra 36 months. So that's 2.5 times leverage. So just know the funding, it's all paid for in one solution. So we pay for this rider out of the monthly charges of the base annuity. So you'll see in any of those illustrations where we're paying for that on a monthly basis, annual basis, it'll show that in the ledger portions. So the great news about these are all non-cancelable, and those premiums can never increase. Now, because we've got this continuation of benefits rider included, of course, we're going to have this telephone interview required as well. And that's because we built in the COB portion with this. So let me just give you a quick example. Here's a female, age 65. Again, it doesn't matter if it was cash or a current annuity, but there was 100,000 that they put in this, right? She had 100,000. We decided to take out an Annuity Care 2 solution for 100,000. Well, that $100,000 is going to pay out single individual, right, over 24 months. So we take that 100,000 divided by the 24 months. That gives her a $4,200 monthly LTC benefit. Or if you want to look at it on an annual basis, which may be even more impressive, over $50,000 annually for her to use for any long-term care services. That's just the base policy. But remember, this solution, that $100 or $100,000 paid for both the base policy and the continuation of benefits rider. So that added another 72 months. So that's really that 4 times leverage that we're talking about. And what a great solution that was. She gave us $100,000. We give her $400,000 to use. So now she's got 96 months, so 8 years, right, of a payout annually of over $50,000, or this $4,200 monthly LTC benefit. So what a great policy this is. We're seeing a lot of business on this particular solution. Just the straight leverage play. It's probably the easiest to explain because that one single dump in, again, whether it's cash, a 1035 exchange, whatever that is, pays for both the base policy and the COB rider. Now, do you want better than 4 times leverage? Do you know what's better than 4 times leverage? Well, how about if I could show you an idea that would pay out for as long as that individual, or if it was a joint couple, as long as either one of them needed. You want to talk about leverage, that's leverage. So I want to really focus now on our indexed annuity care solution. You're going to notice some similarities here with the base policy, depending on if it's a single or a joint. That just shows you how quickly that base policy pays out. So exactly the same as Annuity Care 2. But here's where it starts to differ. We'll go all the way up to age 85 in this particular solution. So 40 to age 85 now. So you get an extra 5 years of planning that maybe somebody really forgot to do a plan, or maybe you've got a client that is still in good health that fits in that marketplace, and gosh, we can offer her a great, or him a great solution. So this is a fixed indexed annuity. Obviously all the upside potential because it's linked to the S&P 500. We've got 5 different crediting solutions on that. Obviously a very simple one, the fixed rate. Then we've got annual caps and pars and monthly caps and pars. So ways to grow that money in and of itself. Funding options here are basically the same, except we could use qualified money in this particular solution where we couldn't use it in our Annuity Care 2. Now, I show you that we can use qualified money here. That negates the Pension Protection Act eligibility for it because any of those benefits are going to be taxable out of that base policy. Why? Because they used it on a pre-tax basis, and the government is going to get their money some way, somehow. We've got a great solution on our life chassis for using qualified money, and that's typically where I sit. So if you've got clients with qualified funds that you want to use, we've got a much better solution, in my opinion, over there, and I'd love to talk to you about that as well. But then, so there's the base policy. That's how we can fund that. But now we've got the option to add the continuation of benefits rider, right? So we can double the base policy, we can triple the base policy, or we can add a lifetime unlimited amount that would pay for either a single, or if it's a joint, for either person up to their full life. They can never run out of those benefits. So great way to do this. Now, a couple ways that we can put these plans together, still just like the Annuity Care 2, we can do a single deposit and let it pay for both sides. Or I'm going to show you a better way here in just a little minute, but let's do that first and show you how this works as just a single dump in, right? So single pay rider paying for both the base policy and the continuation of benefits rider. Female age 70, she had a $150,000 current annuity, and we just 1035 that into indexed annuity care. So again, what we're going to do, single individual pays out over that 24-month period, right? So that's going to give her $47.31 as a monthly benefit, or nearly $57,000 as an annual benefit for any long-term care services. And we added also paying for, right, the COB rider for lifetime. And you can see kind of how the breakdown of the premiums are attributed here. So about 112,500 for the base policy. So of that 150,000, 112,500 is going towards that base annuity, and 37,500 is paying for that lifetime COB rider. But what that really gives her then is that same allotted amount for as long as she could ever need. So that is true leverage, if you will. Now, that's a great way to do it. It's a very simple way to do it. Set it and forget it, buy both sides with one lump sum. I personally really like to do this on an annual pay rider basis. Meaning, let me show you the same example. Still the same female, age 70, 150,000, if you will, in her current annuity. Everything comes over here, but what we're doing is putting all 150,000 of that into the annuity. So you can see that 150,000 is going in here. Now, what does that do? It's going to beef up her benefits out of that policy. Now she's getting $63.13 as a monthly benefit, or nearly $76,000 per year out of her base policy. And then what we're going to do is we're going to add this COB rider at the time of application, but we're going to fund this annually. And I really like this solution, and here's why. If you go back here and just look, remember, we put an outlay of over 37,000, 37,500 here towards this continuation of benefits rider. Well, what if she never needs it, right? Now what we're doing here is we're giving her more benefit by putting all of this amount into the base policy. So more benefits, right? But we are going to have to annual pay this rider for the rider itself. That keeps that lifetime structure of what her beefed up benefits are. But why I like this is not sunk cost like the one and done solution is. You know, now you've sunk 37,500 into the rider of this, and if she never needs it, that's you know, cost of insurance, if you will. So those heirs would only get to what this 112,418 had grown to when she passes and never needs that. In this particular solution, by doing an annual premium, now there's more to be passed on to the beneficiaries if she never needs it, right? The other thing that I like about this solution, yes, she would have to pay some money here, but once she is into the continuation of benefits portion, that premium is now waived. So she would have it for the first 24 months, but once she's into the COB portion, there's no more premiums due, period. And she still has that same $63.13 per month for as long as she can live, or nearly 76,000. So hopefully that makes sense as far as why I tend to prefer or recommend paying for that COB on an annual basis. But now I really want to quickly touch on underwriting. To be a Pension Protection Act underwriting or Pension Protection Act annuity, we must have some form of underwriting. And here's what we've got. We've got 5 knockout questions. And these are really simple questions. For the most part, the first 3 are just saying, are your clients needing care today? So I'll read through them very quickly, not word for word here, but do your clients, first one, do they use any mechanical devices? Wheelchair, walker, quad cane, motorized scooter, chairlift, you know, respirator, things of that nature. They can answer no, we move on to the second. Do they need any help with their activities of daily living? The bathing, eating, dressing, toileting, transferring, and continence. So if they can answer no there, we move on. The third one, do they have any of the biggie conditions, right? Alzheimer's, dementia, Parkinson's, multiple sclerosis, Lou Gehrig's disease, you know, these big conditions that are out there. So again, the first 3, if they're not needing care today, you'll know that, right? So you can easily pass those no questions, if you will. If they can answer no to those, we move on to the 4th question. Have you ever been diagnosed with AIDS or AIDS-related disorders? That would be a knockout question. And then lastly, are they currently receiving or have they ever received Social Security disability income benefits? They must answer no to all 5 questions in order to be able for any of our annuity care solutions. So wanted to quickly talk about that and show you that's really the underwriting that comes into play. However, do you remember when we add that continuation of benefits rider? So that with Annuity Care 2, it's already built in. With the indexed annuity care solution, you do have to add it at the time of application, but we do no parameds, no APSs. Those are always the long pole in any tent, if you will, as far as underwriting is concerned. But there always will be that brief phone interview, that cognitive review, if you will, anytime that continuation of benefits rider is added. So who should you consider for these solutions? Really, any individual between the ages of 60 and 85. 87 in some instances, but that's really more for our base only program, which I didn't spend time on today. That's another great solution, but I didn't have time to get into that today. They have money, cash or non-qualified annuities, looking for an attractive extended care planning option. Open to alternatives other than self-funding, right? Self-funding is probably the worst way to do it. Why not leverage your money? They wanted to limit the risk of the portfolio and maximize the distribution of those assets, and generally are in good health, right? So that's pretty straightforward. Now, I like to end this just a little bit with a little levity, right? I showed you the silver tsunami at the very beginning of this presentation. And I really wanted to, I pointed out those people that were just going to be wiped out. And there's a lot of Americans that if they don't plan, they can easily be wiped out with any extended care needs. They'll wipe out their full portfolios by not planning. But I want to show you a little levity here in what those clients that do put a plan in place and how they're riding that silver tsunami on their little surfboards. Okay, maybe they're walker surfboards, whatever they are, but they're riding it all the way through their life and just loving it. Lastly, I wanted to give you one QR code that gives you resources to our Annuity Care landing page. So any of the information on Annuity Care, you can just scan this QR code and it'll pull you to a page that we have here for all of our Annuity Care solutions. So if you want more information there, you can certainly do so. And with that, Chad, I'm going to turn it back over for any questions that there may be.
All right, Brent, I am not seeing any questions in the chat box. So what I want to do is thank everyone for your time and attention. Brent, especially to you, thank you for sharing that with us. We will be in touch today. It'll either be Logan or I reaching out, see if we can follow up. But thank you everyone for attending and best of luck to you today. Thanks all.
Thank you all. Thank you, Chad. Thank Imes for having me today.
Thank you very much.